Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and before we get started today, I just want to congratulate Steve from Franklin Park, Illinois. He's the winner of this week's silver giveaway. We'll be sending you a free silver ounce round. Thank you for signing up. And we've had thousands of listeners sign up. Just go to palisaderadio.com for a chance to win your free ounce of silver, and you'll automatically be sent a silver report. Back on the show with us today is George Glasier, returning guest. He's a CEO and president of a company that we own shares in called Western Uranium. George was also the CEO of a company called Energy Fuels. And if you're in the uranium space, you've been in the uranium space the last 10 years, you're very familiar with Energy Fuels. George, welcome back on the program.
Thanks, Colin.
I think a very good way to start this interview off is to ask you a question of just how bad uranium can get. This year has seen most commodities, gold and silver, kind of leading the pack here on an upward move. You've had many commodities go up between 20, 30, 40%, and yet uranium has continued downward. It's now at a spot price of about $25 per pound, which is almost impossible for any company to make money. They say that the cure for low prices is low prices, but everything is about timing. People can only have their money locked up for so long. George, do you have any idea of when this uranium market could turn around?
Well, again, we thought maybe it would turn this fall, and here we're after Labor Day, shortly after Labor Day here in the U.S., and we're not seeing the signs of it yet, but we are seeing a little bit of activity by some of the utilities. They're coming out for some contracts. Of course, the needs don't really come about until, let's say, 2018, 2019, 2020. But now we're seeing at least some requests for bids for some deliveries out there, where some of these utilities basically could go into the spot market now and pick up these low-cost pounds and hold them at a very, very low carrying cost. But I think what they're doing is just trying to judge what the longer-term prices will be in the contracts they could get versus buying now. Now, if the contracts don't come in very attractive to them, they could very well go to the spot market to fill some of their needs in, let's say, 2018, 2019, which would create the additional demand, which will drive up the price. The problem that we've got is there's just not enough demand right now, and there's enough supply, more than the supply, to cover the little demand in the spot market. So I can't tell you for sure if the utilities are going to do that. Obviously, it's financing, but low financing cost is not so much a problem anymore. So they got to weigh buying today at $25 and holding for 2 or 3 years versus maybe a longer-term contract. And I see that we might see more activity in the spot market in the next 2 months to absorb some of this excess supply. But that doesn't mean the price is going to go up. It could stay in the 25, or it could even go down a bit as sellers become very aggressive by the end of the year. And we've seen that. Obviously, many companies want to have a better balance sheet, more cash on the balance sheet by year end and less inventory, so they're motivated to sell at almost any price. And so that means maybe through the end of the year we won't see an upward movement, but could see a little bit more of a drop. I don't anticipate too much more, but it could drop a little bit more as aggressive sellers try to unload some of their inventory.
George, you've been in the space for decades. You've seen the uranium price bottom out. The most recent epic bull market that we had kind of started 2001 to 2002. Can you recollect what it was that kind of flicked the switch from uranium to having bottomed at $6, $7 a pound to having that move where it went well above $100? Do you remember the moment, or was the situation ripe for a couple of years and something just finally went in the background?
Yeah, well, what happened is, the utilities started to come into the market. They started to buy, and the supplies weren't there. And as soon as the supply issue kind of straightened itself out, the price started to move up, and it didn't move up, to $100, but it moved up over a period of time as the supply was used up and the demand came into the market. And that's what we saw in the early 2000s. It drove that price up slowly when we got up to, $138 spot price. which, it shouldn't have. And we had a secondary market then. We had to remember the hedge funds actually buying uranium, which created not an artificial demand, but an additional demand beyond the actual consumer of the product. And so this drove the price, up fairly drastically. But it was the utilities originally that came into the market and started buying and driving the spot price up. And then when the price started up, then you saw the secondary buyers like the hedge funds say, hey, this is an opportunity for profits. They came in and started buying, and then the demand was beyond what the market could supply, and then we saw a ridiculous run up of the price. I don't know if that'll happen this time, but I think the catalyst this time will be utility buying, and that's what started the price run up back in the early 2000s. It didn't just result from the utility buying. Obviously, there was other buyers, but that started, in my opinion.
George, following on that same line of thought, uranium is one of the more protected markets. Gold and silver obviously bought by retail investors. Retail investors can look at many different indicators to guess why gold's moving, when it's going to move. It's traded. It's very liquid. Uranium's spot price is only quoted once a week. Very few people are familiar with it, and of course buyers are limited to utilities and governments. What exactly are you looking at? What kind of information to figure out what kind of delivery interest or market interest is being floated around at any given time?
What we're looking at is really when the utilities start to come in for their request for bids for longer-term contracts. Obviously, we don't see the spot market as much because that's a private market between buyers and sellers. So you see the results of that, but somebody comes into the spot market, you might have an indication that somebody's in the spot market. But what we really know about is the bids for long-term contracts, because those are fairly widely distributed. And we look at that as more of an indicator of the price, because that means the utilities are serious about buying. And in the past 6 months, you've seen very little of it. In the past 2 weeks, we've seen more interest than we have in the last 6 months by the utilities for requests for bids, at least. Now, how many contracts have been signed? Not many yet, but this is the first phase of looking at those contracts. Of course, the spot market, you can get some indication of who's looking, and, some of the reports out there say, okay, we looked at 2 or 3 buyers came in for bids for just one-time deliveries, and these would be spot-related deliveries, whether they're deliveries in the next 6 months or a year out. Usually spot market deals are, within a year's delivery.
Listeners to Palisade Radio will know that I've been exceedingly bullish on uranium for over a year now, and I might look a little bit silly for buying into something that has continued to fall, but there's a fact that only 5% of investors manage to buy within the bottom 20% of a market and then consequently sell within the top 20%. It's just so difficult. You really have to invest based on a long-term fundamental approach, and sometimes the price, as we're having right now, will go against you for a while before it moves in the right direction. But very quickly, you can make up for those small losses you had. George, obviously, you're very bullish on uranium because you're now spending your time putting together Western Uranium. You started, of course, a couple years ago. You have over 100 million pounds of uranium in the ground. You have access to a mill. You have a permit for one of the only mills in the U.S. George, why don't you tell our listeners a little bit about Western Uranium and why you think it's such a fantastic opportunity?
Of course, Western was only formed about 2 years ago and went public about a year ago on the Canadian Stock Exchange, and just recently listed in the U.S. on the OTCQX. But in this short period of time of 2 years, we've become the second largest resource holder in the United States after Energy Fuels, and that's that company you mentioned that I was the CFO and the founder of. Well, we were able to do that because of the low uranium prices, and we acquired our assets at a very, very reasonable price. And in an up market, a high market, we couldn't have done that. So one of the things, the benefit of the low uranium price in the last 2 years has been the formation of this company that has acquired a substantial resource base that wouldn't have been possible at anywhere near these prices, if we were in an up market rather than maybe a stable market that we were a year or so ago in a down market. So we see that as a real advantage. And of course, the biggest problem is, a lot of companies can't raise any money. We were able to raise the money to do what we wanted to do. And we're ready basically to go into production as soon as we see a bit of a change of the price. We don't need the high prices that a number of these companies need, because with our ablation process, we should be one of the lowest cost producers in the world. So we're waiting for a little bit of an increase in price with both uranium and vanadium. Of course, that's the other thing that sets us apart. In our deposits, we also have the secondary product of vanadium, which we've seen the price of vanadium come up in the last year, probably about 35%. And vanadium primarily now is used to alloy steel. But one of the big new uses will be the redox battery, and they're talking about these batteries because of the issues of renewable energy, especially solar and wind, that don't produce all the time. The redox battery stores large amounts of uranium power over and over, and it uses vanadium in the battery. So that could be an additional demand on the vanadium market and drive the price up. So we think that we've got an opportunity to go, with both the uranium market and the vanadium market as they recover, and we're ready to go into production with our 7 permitted mines.
George, mining by itself is a very risky business. You're susceptible to many issues, political risks, risks at a mine site, the commodity prices, of course. Whenever a company throws mining technology into the mix, it really scares me away most of the time, and I've seen so many mining technology companies fail over the last 10 years. So when I initially heard about the concept of ablation, it sounds like a very foreign word. It would certainly scare most investors. When I spent some time with yourself and Russell Fryer to really understand what ablation is all about, it's a very simple concept. It's basically high-pressure tubes shooting ore together, and it releases the uranium and the vanadium in a much higher concentration. Can you talk to our listeners about the simplicity and proven technology of ablation and how you're actually going to use it down in the mine site before you bring any ore out?
Right, and I think you kind of explained, the basic principles of it. It was developed by some scientists in Casper, Wyoming, and it simply is a mechanical process using kinetic energy, no chemicals, to separate the coating of the mineral. It doesn't make any difference whether it's uranium, vanadium, zinc, gold, whatever coats the sand grains. It removes it without using chemicals. In the milling process, we use sulfuric acid to dissolve the uranium off of the ore or the sand grains. But in this process at the mine site, we simply use this high impact energy to remove the coating and leave the clean sand, which basically is the waste, leave it in the mine. So we basically reduce our milling costs drastically and our transportation to the mill drastically, because we can take out 80 to 90% of the waste right at the mine and not ship it to the mill, and thus not have the milling cost or the hauling cost related to that mass. And that's why it's reducing cost. And of course, there's a number of producers around the world that have looked at this, and it's been tested on a number of ores, some from Africa, quite a few from the U.S., and it seems to work on any type of sandstone-hosted uranium deposit. And all of our deposits are that type of deposit. We've tested it on a commercial basis just in the last year, and that's a continuous process. Now, a number of these, as you say, technological advances in mining work in the lab, but they don't work when you have to put it into a continuous production process. And that's what we had to prove, and that's what we did prove. We demonstrated it for some analysts and for some utility buyers that basically shows that this process works on a continuous production basis with a low cost. Obviously, the cost is the key. If it costs you a huge amount to run a process, it doesn't save you any money. But this is a very low-cost, continuous processing technology, and that's why I think it's a little bit different than what you've described as the failures of technology in the mining industry.
For a uranium company to be even thinking about production right now is almost unbelievable for investors. That might even work against you because it's so unbelievable. They say that the global cost of production for most hard rock mines is somewhere between $55 and $65 a pound, a far way off from where we are right now in terms of percentage move for the spot price. When we started talking over a year ago, of course, the uranium price was closer to $36 a pound. It's now down to $25. But as you mentioned before, you have a very significant vanadium credit. And like uranium, vanadium moves drastically in price because it's not necessarily a very big component of production for, say, a steel manufacturer, yet they always need vanadium. So we've seen the vanadium prices move from $3 to $4, which has a very big impact. And it also makes you less susceptible to the uranium price having dropped. I'm not sure exactly what the balance is, but are you still able to go into production at today's vanadium and uranium prices? Does sometime in 2017 seem like a time when Western Uranium could go into production?
Well, yeah, we're aiming for mid to third quarter of 2017 for production, even if the prices don't move much from now. At $25 uranium and $4 vanadium, we make a bit of cash flow. We don't like to sell at those low prices, but it could be, the production could be turned on and we could cash flow, especially at the Sunday Mine Complex where you don't have any large capital expenditures to get going. Now, that's the other problem. The producer might, report that he can produce uranium at $25 a pound, but he needs $100 million to get into production. And that's the problem. They've got very high CapExes, even if their production costs are projected to be low. So where do you get the $100 million when there's, if you got a $25 market and your costs are $25, there's no margin to cover your CapEx. Well, in our case, we don't have any capital to spend. The mine's already there. So at $25, if our production costs were somewhat lower than that, then we make money at $25 because we don't have the $100 million CapEx on that project. So there's the difference there. Our production cost would justify it. But again, we're saying that the profits and the cash flows wouldn't be huge simply because, the price of vanadium and uranium really are not quite where we need them. A year ago, when we were in production, we were at $35, for instance, and about $3 vanadium. That made more sense than 25 and 4, quite frankly. But if we see a recovery slightly of the uranium price and the vanadium price has already recovered, we see that continuing, then you can see that our cash flows could be fairly significant in mid-17. But it all depends. If the uranium price drops to $15, which we don't see that, but if it drops to 15, that changes the whole equation.
Certainly. And in 2006, when George was the CEO of Energy Fuels, I said this on our last interview together, but it's such an incredible thing to say. That stock went up 65-fold in 2006. I believe it had to have been the leader of the whole Canadian exchange in a booming commodity market. That says a lot about uranium, but it really says a lot about George and what he decides to get behind. I love this company because it's got over 100 million pounds of uranium. It ticks the box for optionality. If uranium prices start to go up, you have a lot of exposure to uranium in the ground. On top of that, you already have a mine that's built, permitted, ready to go, and a very cool technology called Ablation, which significantly decreases the cost of production, also the vanadium credit. George, for listeners interested in looking at Western Uranium, of course the ticker symbols on the CSE, WUC, and on the OTCQX you have WSTRF. Do you have anything else to add? And if people want to get in touch with yourself or anybody at the company, how do they do that?
Well, certainly my contact information is on our website. Feel free to call me or email me at any time. I'd love to hear from investors. I always respond. Of course, our investor relationships is handled out of our Connecticut office, but I'm always available for investors who want to talk or send me emails. And the contact information is on our website.
Fantastic. George, thank you so much for coming back on the show. And just a quick reminder for all of our listeners, you can go to PalisadeRadio.com. We have all of our old interviews up there, including our last interview with George. We also have our free silver giveaway. We're giving away a free ounce each and every week. You'll see the banner on the top left. Just click there and put your email in. George, thank you so much for coming back on the program.
Thank you, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?